Good morning, good afternoon, wherever you're from, whatever time it is. My name is Bob Iaccino, and I'm really excited to do this with you guys because this is a subject that's near and dear to my heart. Just by virtue of a quick intro, I've been a trader for about 33 years now, and I started on the CME trading floor. So futures is sort of how I was raised on this stuff. So Plus 500 was kind enough to allow me to speak to you guys about 5 mistakes to avoid when trading futures. Lessons for smarter, more confident trading on Plus 500. Real quick, I just want to read the disclaimer down at the bottom. I believe it's on every slide. I don't remember, but I'm going to read it anyway and do a quick explanation of what it means. Trading in futures and options carries substantial risk of loss and is not suitable for every investor. What that really means is futures allow you to behave like an adult, so please behave like an adult. Don't take excess risk. We don't know your individual financial position, so it's difficult for us to tell you how much risk to take. You have to be an adult about it and know that futures do carry risk like most active trading does. I'm going to wait a couple more minutes before I get started on the meat of this, just to let a few more people join in. All right, I think we've got enough people in here now. If you're saying good morning, if you're saying hello, I appreciate that. I'm going to scroll down to questions when that question time comes. Again, I don't have the questions answered. And as Plus 500 just said, there will be a recording of this. So let's go ahead and get started. The first thing I want to talk to you guys about is if you're not currently demo trading or active trading on Plus 500, it's my view that you should. That is my view. And you do have a commission credit bonus available to you guys right now. It's unlocked by inviting a friend. It's the Invite a Friend program that Plus 500 is doing. You receive a $100 commission credit bonus once your invited friend starts trading. A fifth friend earns you $300 cash. That's a lot, considering how little you need to actually start trading in the micro program on Plus 500. So invite your friends, invite them to join us now if they're not in this webinar, or send them the recording and get them to sign up, and you'll get this bonus. It's all yours. You don't have to share it with anybody. All right. How can futures amplify both profits and losses? This sort of applies to the thing I said, where I said futures trading allows you to be treated like an adult. Futures allows you to take much larger positions than stocks or ETFs do in underlying commodities and equity indices. That's really one of the main benefits of futures, other than the tax benefits that you can find out from your accountant, your CPA, your tax professional. I'm not going to go into that with you guys. But you're actually able to take larger positions using less capital. That's called leverage, okay? And your leverage magnifies both your profits and your losses. It's my specialty to focus on those losses, but I'm going to talk about both real quick. Small errors in trading can lead to big consequences, but can also lead to quicker profits. I don't want you guys to make errors on the profit side, because that does what I call rewarding bad behavior. So I want you guys to go through the process of avoiding common mistakes. The faster that you avoid these mistakes, the faster that you get better outcomes, and you have the concept of those mistakes in your head. So let's go through some of the common mistakes, because again, if you're making these mistakes, you can have bigger profits, but in my experience, you're more likely to have bigger losses. So we're going to take a look at a few of these right now. Mistake number one, trading without risk management. The mistake, perfectly stated, new traders often skip stop losses or profit targets, and one bad move can wipe out gains or entire accounts. Okay, this is one of the interesting things about futures versus stocks very specifically. I had a very big loss in the stock market recently in a stock that I took that had a bad earnings report. I had a stop in place, but because stocks are closed during the week, they have that big period of time where they're closed. My stop loss did get executed, but at a much worse price. Now, that's called slippage. That can happen in futures as well. But if you have stops that you have studied the placement of, you've learned where to place your stops, you have a much better control over your risk capabilities. I use an example all the time of if you have a $25,000 account, and I don't expect you guys to have that large of an account, by the way, and you say, I don't want to lose more than $500, your tendency is to take too large of a position and place your stop $500, which you can see at the bottom. Plus 500 allows you to do that. I recommend people find their stop first and then place their stop below a significant level rather than a dollar amount. And the example I always give is, let's say I bought micro S&P at 66.59 and I put a stop down at 65.74. In this particular case, that's actually just below the August 28th high. And if you're able to do that, you can then use one contract and only risk $425 because that's the way that the micros work. Okay, now that's, again, that's using a percentage on a very large account. But if $500 is all you're comfortable losing, you place that stop 340 ticks away. That's 85 big points in the S&P times 4, which each tick is 25 cents or 0.25. So you have 4 ticks in every one big S&P point. And you can risk $425 on a micro S&P with one contract. If you have a bigger account, you do 2 contracts. But if you find the stop first, your position size will actually allow you to adjust to your maximum risk. And that's one of the things you can do on the Plus 500 app. You're seeing that down here. I don't know if you guys are seeing my cursor. I think you are. You see right down here, I'm circling. You can put your stop loss, trailing stop, or a take profit based on dollars. Okay. If you pre-plan a trade like this, I like to tell people that's the only time that you're thinking clearly about a plan or a trade rather, is before you're in the trade. So I always try to tell people, plan your trade before you're in it. You've all heard that cliche. I actually don't love the cliche that's plan your trade and trade your plan. I'd rather see people plan the entire trade out before they got into it, okay? And what I mean by that is targets and stops. Why do we have profit targets underlined as well as stop losses? Let me explain to you what a target is, okay? A target is a place where an action is demanded. That's how I look at targets. So again, let's say the same example, you got in along in the micro S&P futures at 66.59 and you have a stop at 65.74. You have to have a target in place as well so you know what to do next. And that may be an actual target where you're going to adjust your stop, tighten it up so you have less risk. Another rule I always use is always reduce risk, never increase it. That's what these particular things are for. So if you see stop loss, trailing stop, take profit down here at the bottom of the screen, that's what it looks like on your Plus 500 platform. So you could trail the stop just by hitting the minus button or putting a trailing stop in beforehand, whatever you want to do once the trade is in profit. That's the way that we look at these things. So always trade with a stop loss or a profit target and calculate those things before you're in the trade, not after. Because the only time you're thinking clearly about a trade is before you're in it. Mistake number 2, ignoring margin requirements and leverage, misunderstanding how much capital is required to hold a position, okay? You can clearly see margin requirements on Plus 500. And this is something that excited me about this platform when it first came out. They introduced this right away and they've been tweaking the ease of use ever since. So if you're going to get into a position before you trade, you can see the amount it takes to get in for a day trade right here, to place the order is right here, and then the full margin is going to be this to hold it overnight. This is something you have to know. Otherwise, you're just going to get auto liquidated when the day closes. So make sure you know this. Tighten your stop ups. If you're a day trader, you think this doesn't matter to you. But I'd like you guys to try and understand that day trading isn't necessarily the best thing to classify yourself as, okay? If you classify yourself as a day trader and then you have a trade that's running, you may want to stay in that trade. You may want to hold that trade overnight or for multiple nights if it's running in your direction. One of the cliches we used as older traders was cut your losses and let your winners run. A lot of these cliches have like facts behind them. And the fact of it is, if you're cutting winners early and you're letting losers run, you're going to blow out your account. If you're cutting losers early and then you're cutting profits too early, you're going to blow out your account over time because you are going to eventually end up with a larger loss that you didn't expect through slippage. So make sure you understand margin, liquidation, and the possibility of oversized losses, and you could track it down here. You're going to know this before you get in, before you hit send on that order. It's all down here on this platform. Mistake number 3, not understanding tick size or expiration. So expiration day is something you guys should understand. You do not want to take delivery and you do not want the contract to expire on you before you've rolled out of it. Now, a lot of you may say, well, I trade intraday, it's not going to affect me. But it may affect you because the liquidity of an open futures contract could drop as they transition into the new forward contract or the new front contract. So you want to understand what that is. But I'd say the tick size is the most important thing. Okay, what you can see here is a single contract value. Okay, this basically just expresses how you're able to control a much larger position, which with much less of your capital at hand. Okay, with a much lower amount of capital. Units per contract, 50. Tick size, 25. Okay, this tells you how to watch your trade. This tick value is the most important thing. Okay, how much in dollars is every tick worth as it moves for you and against you? Again, this is at the bottom of your platform. So this allows you to gauge your profit and loss in real time. Misjudging profits and loss potentially, okay, the potential loss and the potential profits you could make, and understanding that liquidity dries up as we get near expiration and the tick value displays your profit for you. I remember I was speaking one time at a conference and I had someone say to me after the speech, so S&P futures, if the S&P moves, the S&P futures moves with it? I said, yes, that's correct. How much? By the appropriate tick size, which you can see very clearly down here. I also always love that the buy and sell, the bid and ask are right down there. That's a really obvious thing to have here. So sell represents the current bid, buy represents the current ask. That's basically a market order represented by these two particular buttons. So again, overlooking tick size and expiration dates. Don't think you're just going to get into crude oil or micro crude oil. It's going to be the same tick size as micro NASDAQ. They're not. So make sure you understand that. Classic mistake. This mistake, I would argue, may be the most important one. Over-trading and chasing losses, jumping into too many trades or revenge trading. I'm smiling at that one because early in my career, I did a lot of that. When you lose in a particular trade, okay, on a particular contract, I might ask for a show of hands of this down the road when we're done, when we get into Q&A. But how many times have you gotten stopped out or you've lost money in a particular asset? And then you've said, I want to get my money back in fill in the blank. In other words, I lose money on a NASDAQ trade. I want to get my money back from the NASDAQ. Or I lose money in an S&P trade. I want to get my money back from the S&P or from crude oil or from gold. It's not a real thing. It's a commodity. It doesn't know you exist. Chasing after a particular loss is the way you empty your account. It's the fastest way to empty your account. That is probably the most important thing that you could learn here right now. Your job as an active trader or an active investor is to put on every good trade you see as per your process. That's your job, not to chase after losses. If you have researched your process, if you've done the work for your trading process, for your plan, your job is to put on every good trade you see. Okay? That's the only thing you need to do as a trader. That's it. Stops, targets should be in your process. They should be in your plan already. And when you lose, I'm not saying if you lose, I'm saying when you lose on a trade, because losing trades are the complementary probability to winning trades. One can't exist without the other. Trading is a zero-sum game. When you win, someone else has lost. When you lost, someone else has won. If you put on every trade you see as per your process, whether you win or lose, you've done your job correctly. That's your job. Now, if you start saying, oh, I lost $100, I want to make that $100 back, you have now failed. You have now failed as a trader. Because I'm telling you, I'm an active trader. I don't call myself a swing trader because my average hold time all in over the last 14 years since I've been tracking it is 26 days. Now, that doesn't mean that I don't get out of trades in the same day. I do. It also doesn't mean I don't hold trades for 3 and 4 and 5 months. I do. So am I a day trader or am I a swing trader? I don't really care about those labels. But one thing I do not do anymore, because I used to do it as well, is get mad because I had a loss and put on another trade right away. If you have not researched stop and reverse, you shouldn't be stopping and reversing. Get stopped out of a long, you go short. I knew a trader years ago. Not going to say his name because his name was unique. But we called him the indicator because he was wrong so much that we used to joke that taking trades in the opposite direction of him guaranteed a win. It was a joke. Okay. One of the traders on my trading floor decided to do it. He lost money. How is that possible? Duration, risk, different position sizes. So when you chase losses, you're incorrectly affecting a process into the markets that you haven't researched, that you haven't studied, and you have not planned out the trade. Now, if you're that one person that has a process that says, I take this trade, and if I'm out, I stop and reverse, and you have stops on both trades, and you have targets on both trades, you're not doing anything wrong. But your only job as a trader is to place every good trade you see. That's it. You can see here on the Plus500 platform that you could use the position dashboard to track your exposure and stay disciplined. It's up here. It's very easy to read and it's very easy to see. So when you're looking at this kind of thing, make sure that jumping into too many trades, by the way, nobody at Plus500, no mentor you're working with, nobody can tell you if you're doing that or not because only you know your process. So only you can understand if you're doing that correctly or not. Mistake number 5, trading emotionally instead of strategically. Excuse me. Let me take a drink of this energy drink here. Let me try reading that again so I don't sound like you guys shouldn't be listening to me. Trading emotionally instead of strategically. Fear and greed override planning. Okay, 2 things on this. A lot of people get into trades and then they exit before a particular piece of data is released. Okay, whether it's non-farm payrolls. Today we have the Fed the Fed rate decision coming out. I have rules around that myself. I can tell you what my rules are, but I'm not going to tell you because a lot of you will implement them, and my rules are designed for my process. But if I am a certain amount in profit before a big event, I will get out. Fear of what's going to happen to your trade will get you cutting profits early all the time. Okay? That's number 1. If you do that, the process that you researched versus your real world returns will be dramatically different. Your real world returns will underperform the process you researched because you're cutting profits early. And I guarantee you, when you researched it, you didn't say, well, if it gets, if I get a little money, I'll get out, but this really should reach this level. Greed is holding losses because you don't want to take the loss. One of the beautiful things about futures, and you may be shocked that I'm saying this is beautiful, the loss is taken out that night, whether you like it or not. The money is removed from your account every single day. So you might as well exit a trade that has gone past your stop and you decided to adjust your stop. That's the second thing. And it applies to the rule that I mentioned earlier, a rule that I hold. Never increase risk, only reduce it. If I have a stop in place when I enter my trade, now that rule takes effect. I can never increase risk. I can only reduce it. So if I have a long position here and I have a stop here and it starts going toward my stop and I move it lower, I've broken a rule. And it's very easy for me to yell at myself later about breaking that rule. So you should use stops because they defend you against your ability or your what traders do, okay, the probability of you dropping a stop so that you don't have to take a loss. Take your losses and then get in the next good trade. And if you've done your research over time, it'll work out for you. If you find that your stops are getting hit and then it automatically goes in your direction, I would argue your stop selection is poor. It's not bad that you got out of a trade. Another thing I would add to this, and down at the bottom, you can see, use demo mode to test strategies and remove emotion. Place stops in demo mode, which, by the way, Plus500, unlimited demo, and the prices are real time. As far as I know, this is the only platform that gives you real-time prices on your demo. So what you can do is you can place trades in demo, place your stop, and when it gets stopped out, see if you placed a good stop or not. Now, that doesn't mean you want to adjust your strategy to never get stopped out. You're going to get stopped out, but you should try and reduce the amount of times that you get stopped out at an obvious level. And you should be picking stops by levels, not by money, as I explained a little while ago. If you pick the stop level first and then adjust your position size versus your dollar risk tolerance, that is going to be a better way to achieve what you want to achieve. So use this demo mode because, again, it's live prices. It's unlimited. As far as I know, Plus500 is the only one that does live prices. If that's changed, you can let me know, but I'm not aware that it did change. How Plus500 Futures helps you avoid these pitfalls. Risk tools built directly into order entry. They're right in your face. So if you don't use them, this is something I tell traders all the time. Put a little hand mirror on your desk. If you don't take advantage of risk tools built directly into order entry, look at the mirror as to whose fault that bad trade was. Transparent margin info, intuitive contract details, demo environment for practice. You have solutions to every one of the mistakes we just went through. Practice them and then use them. Practice them and then use them. Don't be lazy, guys. And I don't mean to knock anyone. I'm just saying that if you're not using the tools available to you, there's a saying, I'm sure you've all heard it. If you only have a hammer, everything you see looks like a nail. You have an entire toolbox here, just right here, along with a lot of other things, including education and webinars like this. You should use them. I'm going to save the rest of the time for questions. But again, I want to go through takeaways while you all prep your questions. Always trade with a risk plan. Know your margin requirements before entering a trade. Understand the contract specs. I don't know why I'm having trouble reading my own work here. Understand contract specs before trading. Avoid over trading. Go for quality trades, not quantity of trades. I promise you that over trading one is a very big deal. If you start chasing losses because you lost, you put in another trade that you haven't planned out, that you haven't researched, even if you win a few of those in the long run, just remember that we said this. In the long run, you're going to blow your account out. Use Plus 500 Futures tools to stay disciplined. And I want you guys to all go on demo or live if you're comfortable with live and apply these practices as soon as today, because it's very important that you guys understand risk before reward. If you take care of risk, reward takes care of itself. If you protect your capital, you're able to trade longer. Another stupid cliche I believe I made up. The best way to be a trader over the long term is to trade for a long time. And the way that you do that is to protect your capital. Guys, we've been at this for about an hour. I hate it if I didn't answer your questions. I really hate that. So you guys can all find me on X if you want to, and you can ask me more questions. I'm pretty active on there. And again, thanks to Plus 500. Take a look at this invite a friend program. If you're already a Plus 500 customer, take advantage of that bonus. I mean, that's a good thing to take advantage of. You guys can start live and understand what I was talking about, live versus demo. But I appreciate your questions. I appreciate you guys listening. Again, find me. It's very easy to find me. You can reach out to Plus 500 too. And hopefully I'll see you guys again soon. Cheers, everybody. Thanks for watching.